On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. There's hope emerging that our economy is turning a corner, but is that possible with so much bad news still around? As always, whether your glass is half full or half empty depends on where you're looking and what you're paying the most attention to. It's also because we can put most economic indicators into two groups, lagging or leading. Lagging indicators are backward looking and they confirm what has already happened. Many of the highest profile releases and the ones that tend to make the headlines fit into this camp. The unemployment rate is a classic. At 5.2%, it's the highest it's been in almost 5 years. The Reserve Bank sees it pushing even higher, although only marginally, in the next release, before it starts to decline. Gross domestic product, or GDP, is another. Changes in GDP are our official measure of economic growth. The next set of forecasts are due out next week, and they're likely to be ugly. A contraction of 0.3% is forecast by the Reserve Bank, and that would be the first negative print since the middle of last year. Inflation is another lagging indicator, and that's not so great right now either. At an annual rate of 2.7%, the headline CPI is pushing back up towards the top of the 1 to 3% target band, and it's expected to hit 3% in the next release. With all of that in mind, you've got to wonder why there's any optimism around. As important and reliable as they are, these lagging indicators tell us what's behind us rather than what's ahead. Some can also be quite dated by the time they're released, such as GDP. The economic contraction we'll likely hear about next week will be for the second quarter of this year, so that's April, May and June. We're well into September now, and what was happening back at Easter isn't hugely relevant to the outlook. To help build an accurate picture of what's ahead of us, we need to keep a close eye on the leading indicators. Leading indicators are forward-looking. They tend to change before the wider economy does, and that means they can offer early signs of what's next. This group includes things like business and consumer confidence surveys, building consents, card spending, or PMIs, which are activity indicators. ANZ's Truckometer, which tracks the flow of traffic and heavy vehicles using NZTA data, is another interesting local one. There are plenty more, and every market watcher or economist will have their own favourites. Many of these are released in a very timely manner, in part because a lot of them are survey-based. The downside of some leading indicators is that they can be a little bit more hit and miss. They can sometimes give false signals, like predicting downturns that never arrive or capturing temporary sentiment shifts that fizzle out or change. Unemployment, GDP and inflation figures aren't perfect either, but at least they're based on actual data and information about what's actually happened. The share market itself is a leading indicator, and it's in fact one of the best. In every US recession since 1950, and there have been 11, the share market has bottomed out and started to rise before the recession ended, by an average of 4 months. That's because the market has always sniffed out a recovery. Shares are really just small slices of companies, and the success of those companies reflects what's happening in the economy. At the first sign of those businesses starting to see better times ahead, the collective wisdom of the investment community picks up on it and prices start to move. Here in New Zealand, the NZX 50 index has posted 4 consecutive monthly gains, which is the longest winning streak in almost 5 years, since back in late 2020, early 2021. The index is up 10% since the end of April, and in part that is due to more upbeat outlook statements during the August reporting season, which has recently wrapped up. Those comments are probably some of the most insightful and useful leading indicators around, even when they're accompanied by subdued profit reports, which are really a lagging indicator in a share market sense because they reflect what's happened in the past. We should expect more negative headlines in the months ahead, and that will start with the upcoming GDP report. However, keep in mind that some indicators tell us more about what's in the rearview mirror than what's ahead of us. For a better steer on what's around the corner, we need to pay attention to the indicators that are more timely and more forward-looking. That is where evidence of a genuine turning point is likely to emerge first. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.